Coming up on today's show, restating the question, what is the point of mining? Blockchain forensics with Martin Harrigan, founder of Quantabytes, a company working to build tools for that exact purpose. Is Bitcoin mining really like gold mining? We break it down. The excitement is palpable in the venture world, with Graham Lawler, founder of ultralight startups. And finally, what's a better analogy for Bitcoin mining? Bingo? Land prospecting? If you have a better idea, email us at adam@letstalkbitcoin.com. Hi, and welcome to Let's Talk Bitcoin, a twice-weekly show focused on the ideas, projects, and people building the new digital economy and the future of money. If you're brand new to Bitcoin and would like to learn more, please visit letstalkbitcoin.com/learn to be directed to the Bitcoin Education Project. My name is Adam B. Levine. I'm a writer and speaker who likes to talk about complicated topics in understandable terms. Joining me in our twice-weekly search for clarity, Andreas M. Antonopoulos is an expert in distributed systems and decentralized networks.
Hi, everyone.
Dr. Stephanie Murphy is a scientist and syndicated radio host.
Hello.
Thanks for joining me again, guys. And Stephanie, thank you very much. I know that you're here with some maladies still from you've been sick for the last week.
Yeah. I don't want to go through the whole saga, but basically I had a sore throat that turned into an ear infection, and let's just say I'm having a little trouble hearing right now. So if you hear me during the show, like doing a little John and just going, what? You'll know why.
Before we get into the news, we're going to talk a little bit about the follow-up from last week's show. Last week, we talked about ASICs. We talked about whether or not ASICs were a good thing or a bad thing in the ecosystem, and kind of playing out the logic, really what the point of mining is. So we've gotten a big response to this, and a lot of it, I think, is valid, but doesn't really understand the point that we're trying to make. It's easy to focus on details when you look at topics like this, because there are all these variables floating around. People have money invested in mining technology. People have money invested into computer hardware that's meant to be efficient at mining. But this sort of misses the point. So to start us off, I wanted to play a clip from the Bitcoin Report, actually one of the other shows that I listen to and one of the longest running shows in the Bitcoin space. You can find it at thebitcoinchannel.com. So here's Brother John F. talking about it.
I wanted to talk about this controversy. Now, they've talked about on Let's Talk Bitcoin, the issue of, is this a danger? Are the ASIC miners a threat to Bitcoin? And the issue being, will there be a 51% violation and hard fork? And some of the solutions proposed. One of the ideas was that supposedly Satoshi's vision was that it was one CPU, one vote. Now, I have to say, as a free market person, to me, that is just one of the stupidest ideas you could come up with. A free market is not a democracy. A free market is about $1, one vote, or one Bitcoin, one vote. In other words, the prices in a free market are determined by the economic strength of the players, barring some sort of monopolistic control and a lack of competition. That's something that is beneficial to everyone. And I think we're seeing that with the rise of all these companies involved in the ASIC miners. If we would have stayed with this idea of one CPU, one vote, which obviously couldn't even be implemented because there are CPUs that are i7s, there are CPUs that are Celerons, so that's not even possible. You'd have differences in CPUs. That's something that is just speculative. It doesn't even make any sense. But even if that were the case, that they had limited it to some type of CPU democracy, then obviously we would not have ever had this type of technological development.
People get caught up on the price argument. And I think that that's where a lot of this confusion comes from. When it comes to this particular argument that I am making, at least I'm not sure about everybody else here, but to my perspective, the reason why one CPU, one vote is important is not because all votes are equal, but because all votes matter. This is akin to saying that, you can vote with dollars, but only certain people can have dollars. Now, that's not to say that people won't be allowed to have ASICs. I'm sure if you want to spend money on them, you can buy them. But the point is that because ASICs and GPUs to a certain extent are so much more efficient it makes it so anyone who doesn't make the investment in that specialized hardware not have a voice. Now, again, that's different from what he was kind of ascribing there, which was more along the lines of the price is the price, is the price and it's determined by market forces. That's fine. But the thing that keeps resonating to me is that Bitcoin as a useful object, that actually doesn't depend on the price. The price is completely irrelevant of that and more just a value of how useful people find it. Whereas actually what you're talking about is that it exists at all. And so long as it exists at all, that is the important part. So price aside, then you look at what is mining supposed to do. And again, to me, mining is supposed to distribute hashing power as widely as possible, because lacking such a wide distribution, it's easier for a regulatory body or a natural disaster or a flaw that's found in the technology to completely unravel the entire network, as opposed to if you have this redundant system. It doesn't even matter if one CPU is better than the other. The point is that they still contribute in a way where, if lacking other competition, they are competitive, as opposed to the situation we have now where mining on a CPU is, a joke at best. Am I missing something here, guys?
Satoshi did say one CPU, one vote. Not supposedly. It's right there in the paper on page 4. So this is not a supposed direction from Satoshi. This was very much the goal. But one CPU, one vote doesn't mean it's not just a matter of counting CPUs. It's a matter of orders of magnitude, right? Essentially, a GPU gives you almost 1,000-fold increase over a CPU, at least. An ASIC gives you another 1,000-fold increase over that. So, it's not just a matter of degrees, it's a matter of orders of magnitude. And that's the main issue. Plus the fact that ASICs are currently not available, there's very little availability in the market, would lead to the kind of centralization that can be easily controlled. I really don't know whether, in fact, the Bitcoin protocol is a free market or should be a free market. Maybe it should be a democracy. It supports a free market, but should the rules by which Bitcoin operates be subject to change by anyone who achieves the highest hashing rate? Because at the end of the day, that's what that vote does. It's not about splitting a 51% attack. It's about when a decision is made by developers to include feature X versus feature Y, the network votes on that decision by deciding whether they adopt the new version and fork one way or another. Essentially, this vote is over the protocol and the math in Bitcoin, not the economy itself. From that perspective, do you really want a situation where the richest Bitcoiners or the people with the most power in the real world who can affect real world ownership of these devices essentially get complete veto over how the network works? I think that's a problem. I don't think that should be the way the market works.
I think the Bitcoin network is essentially a market phenomenon. I don't think it could be a democracy because that kind of requires some kind of centralization. And we all know it's very decentralized. I mean, we could use whatever analogy we want to choose to talk about it, whether it's the network votes or the market speaks or whatever, but it's kind of the same process happening, and it is happening on a decentralized level. I think ultimately that's what we all have in common, right? Our discussion on this show, we were kind of fearing too much centralization happening because of the prevalence of ASICs. He was also kind of afraid of that too. He wants people to be able to have a voice and not be restricted in how much of a voice they could have. So, I don't know, maybe we agree on some level.
Yeah, I think you're very right about that, Stephanie. We do agree on some level. I mean, at the end of the day, we both want to see Bitcoin succeed and be basically free from undue influence. I think that's the main issue. What undue influence can be imposed if you have 4 or 5 orders of magnitude difference between one miner and another? Especially if you take this out to a global phenomenon. You're really saying that a very, very, very small minority who will be able to get high-powered ASICs will control the network entirely. I don't think that's a particularly good idea.
Something else that kind of jumps out at me about this is there's a differentiation that is not being appreciated here between what is good for Bitcoin as a network versus what is good for the price of Bitcoin. And then beyond that, there's another level too. What is good for individual miners? Because, in that statement he made, he said, we wouldn't have had the technological innovation in ASICs without this sort of incentive structure. And I agree with that. But the question is it necessary and is it helpful for anyone besides the miners who can get the newest technology earliest? Bitcoin protocol, the network needs a certain minimum amount of power in the network in order to process everything and make sure things happen in a timely fashion. But once you get past that, isn't it just more of a security mechanism?
I think it's already showing in terms of a drop in adoption. Listen, a lot of people took up Bitcoin in the beginning because this was a way through which they could use their regular computer to generate a small amount of income. That's no longer the case. And that removes a very, very big adoption motivator, especially outside the developed world, where access to technology like ASICs will be restricted. Keep in mind also that ASICs can be restricted by government much more easily than general purpose computing. So switching this from a general purpose computing consensus network to a highly specialized computing consensus network severely impacts the adoption, and I think it already has. If I try mining just for fun, just to see how it works, I'm going to do it on Litecoin or Feathercoin because I simply don't have the ability to do it anymore on Bitcoin.
In addition to the concern about governments monopolizing this sort of technology and saying, okay, well, general purpose computers, we can't do anything about those because they're used for all kinds of things. But these computers, these are specific devices that are used for this one specific thing that we don't like. And so it's easy to ban those. But beyond that, actually, I was having a conversation with somebody. We've been looking at various ways of, funding the show and treating it like a startup and things like that. One of the companies that I was talking to is actually currently developing a ASIC that will never be sold, that is being built on 14 nanometer platform and will be, again, substantially more, sort of I'm looking for here, efficient than anything that's on the market. There was just an announcement that came out this morning or yesterday that was something along the lines of 28 nanometer chips are going to be coming out from, I think it was AMC or ANC, I can't recall, of ASIC hardware. And so they're, again, looking at an exponential increase over what Butterfly Labs has been releasing, what Butterfly Labs has been putting out. You've just got to think that if we still have these exponential increases in performance that are coming out, and it all has to do with efficiency, we're going to have situations like this where companies that simply want to be able to control the network or want to be able to control mining and have, all of the revenue that comes into Bitcoin come into them, just build in-house chips where they don't have to fund from outside sources, because it's not like it's that much money if you're a large capital firm. And then you just do it. Run a giant room full of hyper-efficient ASICs that you never sell to anyone but yourself. I mean, that seems like that's a real problem. And it seems like it's much easier to do that when you can develop specific ASICs that have these advantages versus if you're just using a system that is strictly tied to general purpose computing. You can still build farms of general purpose computers that, that are designed to do this, but it's the efficiency of it that makes it so much more difficult. Yeah.
It doesn't scale 100,000 times more. Hey, Adam, let's ask ourselves, how many 14 nanometer fabs exist in the world? It's a handful. It's literally a handful of fabs that can do 14 nanometer. It's a $2-3 billion investment to have a 14 nanometer fab. If 3 or 4 companies have 14 nanometer fabs and can develop these ASICs, I say we rename those companies and call them the Global Federal Reserve. Because that's what they are. And as soon as you have a government that's able to say, hey, let's ban ASICs in the States. Oh, oops. Now the States is no longer involved in above the board mining. And it's fairly easy to find who's mining. And so now the Federal Reserve of Samsung in China is running the Bitcoin network and all of the decisions. Very dangerous situation.
And that's the fear. I mean, I think that's the thing that we're coming up against. And it's not like this hasn't been true since the beginning. It's just that the pace at which it's happened. If you talk to people who were involved with Bitcoin 4 years ago when it was getting started, it's not like ASICs hadn't occurred to them. It's not like graphics cards hadn't occurred to them. It's just that nobody understood the pace at which this incentivized progression would actually be able to take place. And so we're to a place much, much further down the road than anybody ever thought that we would be, both in terms of price, but also in terms of network complexity and just the number of players in it. And so, yes, it's good that there are 4 or 5 ASIC players out there. But the point remains is that it's 4 or 5 ASICs players out there versus the entirety of the general computing network, the entirety of internet savvy computers, and phones. I mean, once you toss in phones to that, we have all of these users who are completely disenfranchised when it comes to mining. And the only way they can participate is to buy in or to work in. But you can't participate in mining anymore. I'm not sure that that's the way things should be. And frankly, I don't think that, however you want to describe it, it's good for the network. Let's Talk Bitcoin is heard each week by thousands of people who are participating in the new digital economy. Our listener base of Bitcoin owners, miners, investors, technologists, and merchants is growing fast. We offer a limited number of short advertising slots in each show to keep our listeners engaged and to provide maximum impact for our sponsors. If you'd like to talk to us about Let's Talk Bitcoin, send us an email at sponsors@letstalkbitcoin.com.
If I showed you a website where you could easily purchase electronics from the world's largest distributor with Bitcoins at 0% markup, would you think it was too good to be true? Good news. It's real, and it's at bitcoinstore.com. Choose from 500,000 items, save money over Amazon and Newegg, and convert your Bitcoins to real-world items. You can even buy with privacy. All they need is a shipping address. But don't take my word for it. See for yourself at bitcoinstore.com.
Forensic accounting is not a new topic, and the public ledger system around which cryptocurrencies are built, on the one hand, opens that process to anyone wanting to get involved. But on the other hand, since the blockchain is a ledger not just for an individual or company, but rather that it covers the entire network, there's a pretty unreasonable amount of data and also highly incomplete information about what identities control which addresses within that data. This is something that we ran headlong into recently on a story where we were trying to run down essentially where money was routed after the DEA supposedly took possession of a number of Bitcoins. We really were not able to get too much further past determining that it did in fact go into the system and kind of continued moving around a lot from there. I'm here with Martin Harrigan today from Quantibyte, who is working on solving some of these problems and actually has done, as far as I can tell, just about more blockchain forensics than anybody else in this space. Martin, thanks for joining us this evening.
Hi, Adam.
You're a principal at Quantibyte. Can you tell us a little bit about what you're trying to do there?
Quantibyte is just a kind of an amateur effort so far to provide tools for analyzing and visualizing the blockchain. So what we want to do is we want to take this thing called the blockchain, this fundamental data structure that Bitcoin is essentially built on, and provide some tools that will allow people to get better insight into what's actually going on there. As your listeners probably know, the blockchain is essentially this distributed ledger. So it's this a public account of which addresses own which Bitcoins. And the interesting thing about the blockchain is that it's publicly available. In fact, in order to participate in the Bitcoin network, the first thing your Bitcoin client has to do is it has to download the blockchain. And what we can do is we can perform different kinds of analysis on this blockchain to try and monitor and watch the flows of Bitcoin over time. So what we're trying to do is provide some tools that will enable this type of analysis, essentially.
So right now, this is something where you're right. There aren't a lot of tools out there, and it's exciting to hear that you're developing some. What can we do right now, looking at the blockchain as a whole? What can we learn from it at this point with the limited tools that are available?
Okay, so the type of things we can do, I think, can be broken down into two categories. You can do macro type analysis, first of all, where you can essentially look at high-level statistics over time. So the simplest things are already being done. There's charts on many websites that show, for instance, the number of transactions over time, the quantity of, say, Bitcoins that are residing at different addresses. You can look at how the distribution of these balances change over time. So, for instance, are addresses holding smaller balances as time progresses or as the value of Bitcoin increases? Now, there's other more advanced things. Then you can look at measures like Bitcoin days destroyed, which is a metric sort of similar to the velocity of money, and this can give you an indication of whether old or new Bitcoins are being spent. On the other side, then you can look at microtype analysis. So you can try and zoom in on a particular transaction or a particular group of addresses you're interested in. And you can try and piece together actually what happened here. So was someone trying to consolidate a bunch of Bitcoins together? Were they trying to obfuscate the flow of Bitcoins by mixing them or sending them through some long chain of addresses? And you, for one reason or another, you can try and get some insight into what maybe the person was trying to do. We also, myself and a colleague, about a year and a half, or actually 2 years ago now, we looked into the case to know, could you actually identify who some of these participants were by looking at activity in the blockchain? And again, if you take the blockchain in isolation, there is very little you can say about who's performing what. But in some cases, if you mix it in with, say, third-party data sources, so say if you have some other information that might attach Bitcoin addresses to IP addresses or something like this, you might be able to piece together in some cases who is involved in which transactions. And again, to stress here, the general answer is that you can't say who's behind a given, say, public key or something like that. But in some cases, you might be able to piece it together. And this could be important maybe if someone is performing an investigation or if they're trying to work out, maybe just searching for clues or something like this. It's one thing that they can look into.
So you mentioned that there's, you've got the micro side and you've got the macro side. One of the things that we ran into is that the only parties we were able to identify in our investigation, trying to figure out where these Bitcoins went, was we were able to at least get pretty close to saying that at least 10% of the coins that went through this particular address we were looking at some point in their life cycle after this incident went through an exchange called BTCE, because we were able to correlate a 3 days worth of downtime, essentially, where that was a time where that address had not been active. So I mean that was kind of a lucky thing where we were able to make that connection. And actually it was with the help of a listener who gave us kind of some information about that side of it. Do you think that when you introduce the tools that you're talking about, how much data is going to be available at that point? Is it, identifying, or is there always going to be this requirement for third-party outside information if you want to get real deep?
Yes, I think you will always need some third-party source of information. If you take the blockchain on its own, I think no matter how sophisticated your tools are, there are still very hard limits as to what you can learn. However, if you take the example of someone who might have access to additional information, if I pick, just to pick one for example, if you pick someone who operates a website like blockexplorer.com or blockchain.info or something like this, they are potentially gathering a lot of very, very interesting information about what IP addresses are being used to access what account balances. And again, if you had access to this type of information and you had some correlation between access logs on a web server and what actual public key addresses people are looking at, you wouldn't be able to, of course, draw any conclusions as to who owns what, but you would be able to see over time potentially who are interested, which people are interested in which public keys. And this type of information people can leak without really realizing. So you might have, a small balance of Bitcoins that you keep in some public key address, and you might have put them in cold storage. But then you may have a habit of just checking that address occasionally by looking at the balance on a website like Block Explorer or blockchain.info. And it's kind of interesting to think that third party would then have that type of information. So if they were to say correlate, sorry, I'm going to have to start again.
No, that's fine. That's
fine. If they were to correlate accesses, say people accessing through a certain IP address and the balances that were in certain accounts, then they might be able to learn interesting things that way as well.
That's really interesting. So the greatest leaks, or at least the most obvious leaks here, are really these centralized services where you can check accounts, because, the accounts that I would check, I might check ones of people that I know. I might check ones of people who, not necessarily people, but I might just check addresses that I'm interested in. And I would also check my own. And so by capturing that and associating with an IP address, then you're able to really, really narrow down, okay, this IP address has an interest in this one, this one, this one, and start building networks of essentially correlations. Is that possible if you're not using a service like blockchain? Like if I never go to blockchain.info or I never go to one of these outside address checkers, then do I leak that information through using my Bitcoin client, or is it just an online thing?
It's just essentially an online thing. If you are very careful, it's certainly possible to use Bitcoin in a way that you won't leak information like this. Having said that, there is still the potential, even though I haven't actually seen it deployed, where someone, for instance, if they were connected to your local Bitcoin client at the peer-to-peer level, say if that same person was also connected to a large portion of other nodes on the peer-to-peer network, and say if they saw, for example, that a new transaction appeared from your node first. Of course, they can't say with certainty, but they might be able to make the guess that the transaction actually originated from your client. Now, again, it is possible to work around this, and it's possible if the person who's operating the client knows what they're doing to do things so that this can't happen. But in the general case, it is possible that someone could leak information like that.
One of the other questions that I've had, there are people out there who use one public address for just about everything. I've seen this before, and it always surprises me because it's very, very easy to make another address and to just use a new address basically with every transaction. The way that I wind up treating it is almost like a checkbook memo space where you can write a little note about what that exact transaction was for, so you can keep it for your records later. Is there a difference in terms of security and in terms of how much information you're putting out there if you're using a unique address for each transaction you do, or if you're using one for everything?
There is, certainly. If you take, say, the Bitcoin QFT client as an example, when you send Bitcoins using that piece of software, there isn't like a from field like there is in an email client. Essentially, all you do is you paste in the public key of the address you want to send the Bitcoins to. But under the hood, the client does actually use a type of from field. I'm kind of simplifying a little. If you want to send 100 Bitcoins to someone else, your client has to create a transaction where it indicates where those 100 Bitcoins came from. And if you only ever accept Bitcoins using one address, then of course those 100 Bitcoins have to come from that address. So you've essentially said in this new transaction that I'm transferring 100 Bitcoins from this old address, which I've already publicly said I own, and I'm sending it to this new address. And of course, that's very easy for someone who is analyzing the blockchain to see that. Now, if you go a step further and you start creating unique addresses every time you want to receive some new Bitcoins, then essentially what the client does is it'll pick a subset of your existing addresses and consolidate together some Bitcoin from those addresses and send it on to the new person. The danger here, if you're using the standard client, is you can't really tell how it essentially put these Bitcoins together. So which of your previous addresses did it use when it was creating this new transaction? This can kind of surprise people, I think, because what they might have is they might have one, say, public key that they use for receiving donations, and then maybe they've used other unique addresses for receiving other amounts. But then when they go to make a transaction, what actually happens is the client might consolidate together some Bitcoins from your public address and from a subset of your private addresses. What the transaction then shows, and again, there are ways around this, but in the general case, what it shows is that all those addresses at the time of the transaction were under the control of the same person. So again, you've sort of given away the fact that the person who owns the public address and the person who owns a subset of these private addresses is actually the same person. I think this is very non-intuitive to some people when they use the Bitcoin client for the first time, because all they see in the UI, for instance, is that they're pasting in this new public key address. It's a hexadecimal string of letters and numbers. It all looks very anonymous. And there's no indication what information they've just given away. And what they've actually given away is that of the other addresses that are in my wallet, I'm grouping together a bunch of Bitcoins in order to make this new transaction. And I think that can surprise people sometimes.
One of the other things that I've been noticing as I kind of go around the internet is that, especially on Bitcoin-centric sites or just altcoin, this is not specific to Bitcoin, of course. This is any sort of cryptocurrency we're really talking about here. It's just that Bitcoin is the largest player right now. There's a common practice of pasting a Bitcoin public address in like forum profiles and things that really identify people to those particular things. That's basically like an even larger breach than you would get with one of these blockchain.info services, right? I mean, because you're just flat out associating identity with address.
Yes. Yeah. Exactly. What's dangerous then is that those addresses can potentially be linked with private addresses that you're also using. So even though you might have only disclosed one address, you might have 6 or 7 other addresses that you don't disclose, but in the course of making transactions using your client, you might indicate that it's possible that the same person actually owns all of the addresses.
So from even that one public address, if someone is looking hard enough, they can track it back and see if there are other correlations where that you're saying that the balance that comes from that publicly displayed address can be combined with other non-publicly displayed ones, which then creates a correlation, which makes it so that, if someone wanted to look, they can say, okay, well, this person, this transaction combined this, and this. We know that this person owns at least this address. And that implies that since these other addresses are in the same transaction, they are also owned by that same person who publicly displayed.
Yes, exactly. And even though there are ways around this, so it is possible for someone to deny this. It's not like a hard and fast proof that they own them. But what I would say is that in a lot of cases, in general use, it would be a good indicator that the same person is in control of the different addresses, yes. We gave the example before of the WikiLeaks website. Again, it's about 2 years ago. They broadcast a tweet. This was in the earlier days of Bitcoin, saying that they were accepting anonymous donations on this address, and they gave a Bitcoin public key. And people then may have made anonymous donations to this address. What they may not have realized is that in doing so, anyone who saw that public key address could easily identify all the transactions that were donations. And then they could take a look at what keys did those transactions originate from. And then they could see, could they identify any of those people? So just by sending Bitcoins to that address, it certainly didn't guarantee that you were anonymous. And if you take that a step further, what they've moved to now is every time you make a donation, they generate a new address. And that's certainly better. But the danger is that, say someone automatically makes a small donation every week and they keep a record of what address WikiLeaks used to receive that donation. They could then monitor the blockchain to see if the balances in those addresses were ever linked together with other addresses. So if they knew, say, 50 addresses that they had used to make, say, donations to WikiLeaks, they could see whether those 50 addresses were ever linked with other addresses. And in doing so, they could make an educated guess that all those addresses were in fact used for donations to WikiLeaks. And that's potentially dangerous, I think.
So let's talk about mixer services for a second here. This is definitely something we ran into going through this investigation, trying to figure out what exactly happened. And what wound up happening is it looked like it went through a series of probably about 100 mixer transactions where the full amount goes through and a small amount peels off and goes somewhere else and then starts its own little side chain. And basically the point isn't that you can actually eliminate the connections. The point is that you can confuse the connections by throwing so much information out. Is that right? So is that effective? Can you actually hide with mixer transactions, or is it just make it more difficult?
If you have a public key that has a certain balance and you want to try and obfuscate it or obscure that fact, you can first try to, say, divide that balance into smaller amounts, send them through a series of different addresses, maybe join them together at a later date. And if you do this on your own, it certainly makes it more difficult to see. In the blockchain, you would have to look at the flow of Bitcoins over time. Even though it's deniable, I would say you haven't completely obscured the fact that you still own these Bitcoins. So there are techniques from network analysis and graph analysis where you can follow the flow of something like Bitcoins over time. And again, you could see that maybe 100 or 200 transactions later, the person merged together flows from several different transactions, and you can see that they brought them back together again. And again, someone could make an educated guess that it's the same person is in control of this. You could thereby say that you could maybe follow the flow of Bitcoins over time. Now, again, it's very deniable. The person who did it could claim that the very minute they left the first address, they didn't own them after that. It's certainly not completely obscured. And if you were looking for a clue as to where to investigate next, it might point you to another centralized service, a wallet or a mixer that you could maybe contact and see if they could tell you who was in control of a certain address. I think you can try to obscure and hide it by doing these types of things, but it's not clear whether it would always be successful. I think it's interesting to note in this case, in some, say, reported robberies of Bitcoins in the past, what used to happen maybe a year and a half ago is you would often see these types of obfuscated, obscured flows after a robbery, say, would occur. But more lately, some of the more recent robberies, they don't actually happen like this. What happens is the Bitcoins are stolen and they generally stay in some address. There's potentially two reasons for this. I mean, first is that maybe the person who stole the Bitcoins is just speculating that the price is going to rise in the future and they don't want to cash out yet. But I think more likely is that it's not clear how best you would actually move these Bitcoins to, say, an exchange so that you could cash out without anybody ever finding out it was you. I don't think it's immediately obvious how you could do that completely anonymously at the moment.
So with Quantabytes, you're building some tools to make some of this process of being able to, essentially extract information from the blockchain, both in the macro and micro sense. What tools are you specifically pushing towards? What areas do you think really need the work?
There's essentially three different types of tools I hope to provide. The first is just some simple tools for processing and parsing the blockchain. Even though the blockchain is publicly available and anyone who's running the Bitcoin Qt client essentially has a copy of this, I think it could be in a format that would make it easier for certain types of analysis. Now, some people have already made an effort of this where you can download kind of human readable versions of the blockchain. This is the I hope to provide. The second thing will be a collection of network analysis tools. So these will be things where you could identify a certain public key you're interested in, and then you could visualize the flow of Bitcoins from this address over time. So you could watch for, say, very fast flows. If someone had a certain balance in a certain account and they wanted to quickly move it between a series of accounts, it could identify things like that. It could watch for, say, large balances of Bitcoins being divided over time, then merged and consolidated back together again, and maybe smaller portions being siphoned off. Things like this, which you can do with network analysis. And the third thing is tools for visualizing this kind of output. This type of analysis is something that really needs a human, where they can look at the accounts, they can look at the addresses, they can try and see what was happening over time. And again, there are some tools from network analysis that can help to actually draw these types of pictures. That's essentially the three types of tools I hope to provide.
If you are trying to do something private on the blockchain, is this a concern for you? Do you think this is something that the average user needs to be concerned about? I mean, regardless of whether or not they want something to be private, I think there's an expectation when you're dealing with Bitcoin that these transactions are private. So is that a wrong assumption, or is there still so much data out there that it is pretty much anonymous? It is pretty much safe no matter what?
That's a difficult question, because if you do something, I think, using Bitcoin at the moment, maybe no one will find out, say, that you've performed a certain transaction. But in doing so, you have to make sure that no one in the future will be able to look back and piece together the information. And also you have to make sure that you won't do anything in the future that will disclose some information that might reveal what you did. So again, to make an example, you might make a perfectly anonymous donation to some Bitcoin address using some Bitcoins that you hadn't in any way linked to your public identity. But the danger is, maybe in a year's time, you might make another transaction that might link together one of the addresses used in that transaction with some other address that maybe could be linked with your public identity. I suppose what I would say is that you certainly can't assume that everything you do in Bitcoin is completely anonymous. If you really want it to be, you have to be very careful and very sure that you know what you're doing.
So, Martin, this is clearly, a developing issue. If someone listening to this is interested and wants to get in touch with you or join the project, what's the procedure for that?
The website is quantabytes.com, and you can contact me at martin@quantabytes.com.
Well, thank you very much for your perspective, Martin. This is a really interesting topic, and I think it's really poorly understood, so I really appreciate you taking the time with us today.
Okay, thanks. It was great talking with you.
We have a couple of other comments here that I wanted to get to. These all came in from anonymous reader mails submitted through the Tumblr. We're going to be changing the way we do listener mail when we relaunch the site, but for now, this is what we've got. If a large corporation wanted to make an investment and start an ASIC farm, they could potentially take over the network. Is there any reality to switching to script? Would that solve anything? Would it bring new problems? Thanks.
Switching to script would certainly solve things temporarily. I don't think it's a permanent fix, because while it does squash the difference between ASICs, FPGAs, GPU miners, and CPU miners, it will also lead to additional development to overcome that difference and more specialized hardware. While script will definitely kind of shore up this problem for a couple of years, what we should be thinking about is a more flexible way of having possibly multiple different proof of work algorithms, or the ability to change proof of work algorithm as certain proof of work algorithms prove to be essentially too easy to game and centralize in such a way that really does not represent a healthy environment for Bitcoin. So yeah, script would definitely solve the problem. And I think, the nice thing about this is if there is a free market here, the free market exists in the sense that if we continue down this road of centralization and there's capture of centers of mining, people will vote with their wallets and leave en masse for Litecoin or another coin that has a proof of work algorithm that works better. So I'm not worried in the long term about cryptocurrency survival. However, I do think that this is certainly one of the core weaknesses of Bitcoin.
Just to clarify, when this person is talking about switching to script, does he mean just people starting to use Litecoins instead of Bitcoins, or does he mean actually changing something about Bitcoin itself to make it run on script algorithm? Because that seems like it would be very difficult to do technically.
Technically, it's not difficult at all to do, Stephanie. The infrastructure is there. So essentially, those kinds of changes would require a hard fork. And usually the way something like that would be introduced is to say something like this. For the next version of the client, there's going to be a switch in it. And it's going to say, if the block is less than, 280,000 block height, then we're going to accept any blocks that are mined through a proof of work algorithm double SHA. If it's over 280,000 block height, then the client will only accept blocks that are mined using script. And so you have a specific point in time based on the block height that the cutoff occurs. And you gradually phase out old clients before that cutoff occurs. Otherwise, those clients are not able to do mining. And end users wouldn't need to change anything. Only miners would need to change. This has happened before. We've done hard forks like this before, planned as well as somewhat unplanned. So it's totally possible to change the proof of work in Bitcoin. And I think, as Dan Kaminsky said, it's going to be inevitable.
Possible is very different from likely, though. And that's kind of the key of the issue and the thing that makes it interesting to look into Bitcoin's future and see where we're going with this whole ASIC thing. Yes, you're right. Miners could absolutely start switching to script, but miners who have made a significant investment into ASIC hardware have all kinds of reasons to not do this. We're in a situation right now where there are at least 3 ASIC pre-orders that are floating around. Butterfly Labs is not the least of them. And all told, you've got somewhere in the range of 30 to 50,000 units that essentially have to go out to people before we even know what the total network hash is going to be at some kind of equilibrium. And that's not anticipated to happen until beginning of next year. I think this is an issue. And I think that you're going to find a lot of reticence from the community as a whole to this simply because so many people are still waiting for their ASICs. I don't know how we fix this, but yeah, if we could fix it, and again, I'm not sure that script is necessarily the solution here because it has a lot of these problems too. If a guy wanted to, the thing to focus on for improving the future for cryptocurrencies broadly moving forward would be in figuring out an algorithm that was as efficient as possible on a piece of hardware that is so widely spread, anybody who wants to simply opt into the system and start using it can without having to purchase anything new. Like if we can figure that out, this is a system where instead of incentivizing the people who are the most committed, instead you incentivize everyone. Because money isn't about the people who are most committed. Money is about everyone. Everyone uses money because it's a natural form of commerce. The incentives are so screwed up right now because of this pre-order thing. Imagine if instead of ASICs being pre-ordered, ASICs were brought to market and then sold. And instead of having to wait a year for getting your ASIC or wait 6 months or 3 months for getting your ASIC, it was just you ordered it and then 2 weeks later you had it. We wouldn't have any of this reticence. There wouldn't be any problem with it whatsoever because people would have their equipment. They would be profiting from it at a time that actually makes sense relative to their investment. And so moving forward, they'd be able to look at the situation at least from a somewhat clear perspective and say, okay, well, this makes sense. That makes sense. But because we have this, you invest in front and then you get the payoff way at some point in the future and nobody really knows when that's going to be. It's a very, very stressful thing, I think.
I don't really think that having more availability of ASICs would substantially solve this problem because you still have multiple orders of magnitude difference in range of hashing power. From a 14 nanometer to a 28 nanometer to a 48 nanometer or to a regular GPU, FPGA, or CPU. The range is simply too great. And having a range that is that great invites centralization. And centralization is very negative for Bitcoin. So I'm really concerned about an opposite scenario, which is if Bitcoin simply becomes the developed world's currency because only those who can afford ASICs can participate, then essentially it becomes a niche currency and people will walk. And one of the potential dangers from that, if we don't fix this early enough, the mining difficulty will keep climbing. And if people walk at a point where the mining difficulty is very, very high and can only be supported by distributed ASICs, you might find yourself in a very similar situation to Terracoin, where it takes months to mine the next block, not 10 minutes, and the entire network grinds to a halt. If the difficulty overshoots the network caching capacity and people drop out, that's a real danger. I think that's the primary failure mode from a technology perspective for Bitcoin.
So another one of these emails, I think you should compare mining more to gold mining. Quote, I shouldn't be allowed to use a geologist or a rock crusher or a metal detector or a sluice just because some drunk down the road spends all his gold that he finds from panning on booze instead of investing it in more sophisticated equipment. This is an interesting question, but I think that it is a little bit too narrow. So to expand it a little bit, I think that, yes, you can do that, but only if the guy further upstream can set up a full industrial scale mining system that completely cleans out the stream downstream to you that you had previously been hoping to profit from. So yes, you have all this new equipment, but someone else has just obsoleted your new equipment with his new equipment. And because there's a fixed amount that is released at any given time, that is to your detriment directly rather than as some sort of, with gold mining, the differentiation is that it's like all the gold mines in the world are connected to each other at the center of the earth. And if you pull, gold out in India, it also comes out of Montana. There's less gold in Montana to find. So, I mean, that's the problem here is that there's always a bigger player, and the game itself incentivizes players to come in and be as big as possible, because by being as big as possible, you maximize your return. And it's a more efficient process if you can control 20% of the network than if you can control 21% of the network.
So I think the gold analogy is pretty instructive, because in gold, you don't have a method that is 100,000 or a million times more efficient than another method. And if you did have such a method, then instantly gold production would centralize in any location where that method was applicable or available, and then it would be controlled. So essentially you would have massive control over gold production. I think that's already happened in some ways, in that it's actually gold production is very centralized at the moment to, a few mines in South Africa and a few other places. And as a result, that leads to essentially trading on derivatives of gold that don't have physical gold attached to them because of the distribution problem. But if you suddenly had a method that was a million times more efficient, what it would do is it would completely imbalance the production of gold and tank the price. We've seen this happen with aluminum. When a method for extracting aluminum was developed that was literally a million times more efficient, it permanently disrupted the production of aluminum from everywhere. But the difference is we're not using that as our currency. So it doesn't matter if that commodity suddenly gets more expensive or changes, because the people who are extracting aluminum and selling it don't determine the rules by which extracted aluminum reaches the market. If they did, then they would instantly turn it into a monopoly. They would instantly prevent any other competition, and they would change the rules to suit them. So the problem is that this encourages the kind of market where you have complete market failure, because you have so much sudden centralization, and then you hand the rule control over to the people who have the ASICs, and good luck with that.
There's another thing about gold mining too, which is that gold mining doesn't have a difficulty. Like, for instance, if somebody develops a really efficient method of gold mining, or a bunch of gold miners jump into mining at the same time, the difficulty of mining gold doesn't change. There's always just so much gold in the earth. But that's not true with Bitcoin, because the greater the hashing power of the network, the more difficult the network adjusts to become, so that it does become more difficult to do the mining. So there's another difference there.
Mining is a terrible metaphor. It really doesn't encompass at all the process of minting new Bitcoin. And all it does is it creates this false analogy where people tend to draw conclusions based on physical systems that have no relationship to Bitcoin mining. So I think the term mining itself is extremely bad and misleading.
EasyDNS is the Swiss Army knife for your domain names, helping meet their customers' individual needs since 1998. EasyDNS has been an outspoken critic of SOPA and CISPA. EasyDNS was an early supporter of Bitcoin, and now they are proud to sponsor this show. Do business with a company that shares your values. Get a 13% discount when you pay with Bitcoin. Go to bitcoin.easydns.com and be sure to use discount code LTB. You're listening to Let's Talk Bitcoin, the premier audiocast providing news and insights that cover the rapidly evolving world of digital money. Our twice-weekly shows include analysis of late-breaking news, updates on key technical, business, and regulatory issues, and in-depth interviews with the key people driving the new digital economy. Let's Talk Bitcoin offers sponsors an attractive way to reach a targeted and savvy audience. For more information, email sponsors@letstalkbitcoin.com.
A lot of times we're talking to innovators in the space. Bitcoin is a moving target, and there's a lot of action happening around it. One of the areas that we don't focus on too much is kind of the funding mechanisms that make some of these improbable companies happen. So I'm joined this morning by Graham Lawler, founder of Ultralight Startups. Graham, you're in the trenches on this stuff as far as actually connecting the companies that want to make these products, that want to perform these services, with the people who can actually provide the funding to make it happen. What's different about the Bitcoin space than other spaces you've worked in?
The level of excitement about Bitcoin is totally unprecedented in anything that I've seen in the 5 years that I've been running Ultralight Startups. We host pitch events where startups pitch to investors. Been doing that for 5 years in New York, Boston, Silicon Valley. We cover kind of all sorts of internet startups, e-commerce and social media and SaaS, enterprise businesses, everything under the sun, as well as energy and clean tech. But I've never seen a sector that has as much interest from VCs and from angels and also from the press, the mainstream press, as Bitcoin does. So I think that's the big difference that I've seen with Bitcoin lately. It's almost reminiscent, and this is what you hear when you talk to people that have been around for a while, is it feels a little bit like the mid-90s when the internet was the thing. And, you had Netscape and the sort of the dot-com era. And that's the level of excitement that I think investors have about Bitcoin.
There was a lot of excitement during the dot-com era, but a lot of it was built on this premise that business model didn't matter. What mattered was eyeballs. You had these things like pets.com where they don't really have a way to be profitable, but yet they still achieve these high valuations. Do you think that there's a potential for a situation like that with Bitcoin?
Probably there is. I mean, I think if you look at some of these trends, and sort of the internet was probably the biggest one in the mid and late 90s, but we had sort of social media and SaaS and other trends as well that have had their own sort of run up and run down in terms of hype.
Of the companies that survived the dot-com era, there are not too many. There are a few, and those few that did survive have become very large. There were a lot of business models out there that never really had a model behind them. One of the things that when we talk to people about Bitcoin, there's kind of never that problem, because Bitcoin, being money, sort of has monetization literally built into anything that it's implemented into. You're running these pitch events. So what sort of businesses are you seeing coming into the Bitcoin space? What trends are you seeing emerge? What is it that people are focused on right now?
There's a parallel along the lines of what you're talking about in that back in the late 90s, and I'm old enough to remember this, anything with a .com in its name just had investor interest just because it was a .com. You saw companies, change their name from whatever to whatever.com, and all of a sudden their market cap would spike, 30% the next day just because it was a .com. I think that there's a little bit of that in Bitcoin. Anybody that's doing anything just has like a Bitcoin-induced bump in it. There's just so much interest, and people are really seeing the potential. They don't necessarily understand how it's all going to play out, kind of like they didn't understand how the internet was going to play out. They don't understand how people are going to end up using it, and how money is going to end up being transferred over the internet. What businesses make sense on the internet versus sort of bricks and mortar or traditional. It was just like the Wild West. Anything that had .com got venture funding, and sometimes at ridiculous, insane valuations. I wouldn't say we're quite there with Bitcoin yet, but I think that there's the potential to be. I guess to answer your other question, like what sort of startups are we seeing? We have 8 startups lined up for our pitch event next Thursday in New York on July 11th. You can see all these on ultralitestartups.com if you go there. But trading applications, we have BTX Trader and Atlas ATS. We have wallet technology, open wallet. We have sort of a Bitcoin and other altcoin trading system called Crypto Street. We have Litecoin, which I'm not sure if it is itself an altcoin or if it's a way to use Bitcoin.
The naming conventions are interesting, aren't they? You know, I mean, you've got lots of companies that are bit, and you've got lots of companies that are coin, and so it's just like, you know, I worked in the green space previously, and it's the same sort of thing there. You know, there was a period of time where any company you looked at had green or clean or something like that in the name. And so it becomes very difficult to actually tell them apart.
That's right. Yes. Litecoin is a company that allows Bitcoin to be built into games so that when you win a level in a game or get a prize in a game, you actually get Bitcoins from it, which I think is an interesting model. Lots of interesting companies in the space. I mean, we've seen remittance systems. I think we've got one or two of those on the lineup, trying to kind of span the gamut of what's possible, you know, and what's out there.
So tell me about the investor side. It seems like right now there's a hunt for yield and there's a hunt for good investments. So, I mean, is Bitcoin just the only thing out there, or is it a hot area, relatively speaking? I mean, where are we on that? Why is Bitcoin seeing so much attention from investors?
See, I think Bitcoin fits the venture capital model really, really well because, you know, the structure of venture capital as an asset class is different from other asset classes. It's fundamentally different from real estate or hedge funds or private equity or public equities in that it's very high risk. You know, most venture capital investments fail, most startups fail, and therefore, if you're a venture capital firm, you're investing in 10 startups, you can expect 5 of them to fail outright, you know, another couple to kind of just return their original investment capital. So therefore, the 1 or 2 that are left that are big successes need to be huge successes in order to pay for everything else. And that's kind of the nature of venture capital. Venture capitalists are always looking for something with a minimum of a 10x return or a 20x return, such that if it works out, it pays for all the losers, which they know they're going to have. It's inevitable. And that's different from all the other asset classes. So they seek out very high risk, very high potential technology sectors. And I think Bitcoin is a perfect fit for that. And it's a perfect fit for venture capital. It's so disruptive that if it works out and if a technology works out, there's plenty of room for 10x or 20x returns to pay for the losers in a VC's portfolio.
What's the story with that risk tolerance there? Because, you know, on the one hand, Bitcoin companies make sense because they have that growth potential, but then on the other hand, they have a lot of risk, from the perspective of the regulatory system. You know, we don't really know what the rules are going to be in 2 weeks, a month, a year, and they could be different at each time as you kind of go along that timeline. How, as an investment company, can you deal with that risk? How do you plan for something like that where it's so uncertain?
It's a great question. A VC needs to get in when it's kind of unknown like this, because once everything shakes out and, you know, we know what the regulations are and sort of some of that risk declines, then it becomes a less risky, you know, asset class, and other investors start to get in, or the potential returns start to decline. It's kind of like the VC's business to go into something explicitly when it's risky. They can mitigate that risk through a few different techniques. I mean, some of the very large VCs actually have an entire operational staff that might be experts in financial services regulation and might, if they have a lot of Bitcoin companies in their portfolio, help to lobby on their behalf or help to navigate the legal system to find a niche that those companies can operate in legally. And the VC itself will help the startups in the portfolio navigate through that.
The risk is the opportunity because they're good at dealing with the risk.
I think that's exactly right.
So you've got your first one of these coming up. So based on the response you've received from this first Bitcoin-focused startup pitch event, what do you think the timeline is going out on this? Is this something you're going to be doing on a regular basis? Do you think there are enough Bitcoin concepts to justify this on a regular basis?
I sure hope so. Like, as I said, we've done pitch events every month in New York for over 5 years now. This is our first Bitcoin one, and it's really driven by my own personal interest. And we did a lot of work to find, I think we had 20 companies apply to present, and there'll be 8 sort of finalists that are actually presenting at the event next Thursday. We did a lot of work working with sort of local Bitcoin meetups, and there are several in New York right now. Bitcoin VCs, there's a couple of Bitcoin VCs in New York, or national services or news groups or social media to drum up interest for this. The applications actually came in from quite far away. They're not all from Metro New York City, but we've got somebody flying in from Vancouver, for example, I think we have somebody coming in from Las Vegas to present. So that's great. My hope is that there's a lot more local Bitcoin startups in the future, and that if we were to rerun this type of event in 6 months, let's say at the end of 2013, that there'll be enough locally we can get a steady stream, and it's not too difficult, just like we are for all the other startup sectors. There's plenty of interest, and I think there's people out there just trying to figure out, what to work on, what's next, where the opportunities are, and I hope that things like our pitch event and upcoming conferences are going to help to solve that and let people know where the opportunities are, and that's where the startups are going to emerge.
So for somebody who maybe has a great business concept in the Bitcoin space that they think might be something that people would want to invest in and that they would want to throw their time behind for a couple of years, can you tell me exactly how these pitch events go? What's the process for a startup participating in one of these?
Sure. Well, I'll tell you about the event itself, and then I'll tell you about the application and selection process. So the event is a 2-hour-long evening event. We have 8 startups pitch. There's a panel of 4 VC investors, and the audience is usually about 200 people. Each startup has 2 minutes to present its idea and business model. Then the panel has 3 minutes for Q&A with each startup, and then the panel has another 3 minutes of advice back to the startup. So each panelist goes down the line and says, if I were you, here's what I would do to take your business to the next level. So we go through the monologue pitch, the Q&A, and the advice from the panel for each startup. We'll do 8 of those. We have sort of a networking section at the beginning, and then halfway through the pitches after 4 of them. At the end of the pitches, the audience votes on their favorite startup in real time by an online form, and we announce the winners, and the winners get some prizes. Not cash prizes, but prizes from our sponsors and partners. We have one Bitcoin-specific prize we just announced, which is with Reddit. So the winning startup gets $200 in advertising credits on Reddit's Bitcoin page.
You mentioned that the winning startups get prizes at the end of it that are, that are valuable but not money. So these are pitch events. Do people get funded from these?
People sometimes get funded. We don't really advertise that as the objective of the event. Really, the objective for the startup is more to get the feedback from the investors and to get exposure to this big community. So a lot of times if a startup is presenting to a VC or to an angel investor, independently offline in their office, the reaction 99 times out of 100 from the VC back to the startup is, that sounds interesting, call me when you have more traction, which is kind of this very generic, lukewarm answer. They don't want to completely say, no, that's a stupid idea, we'd never invest. They get sort of a bad reputation for saying that, and there's always the chance that every startup that comes through the door turns into something big down the line, so they don't want to completely shut the door. So that's why they give that sort of a lukewarm response to everything. Whereas at our pitch events, the investors are required to give their questions and kind of probing into the technology and the business model, and then give this advice, this sort of actionable, if I were you, here's what I would do advice, which is something you never get at an independent meeting. And that's really valuable. So a lot of times, entrepreneurs come in and they get that advice. You should go after this vertical, or you should go after this niche, or partner with this big corporation, or talk to so-and-so about a strategic alliance, or whatever it is. And it's very concrete, very actionable advice back to the startup. And that's the core value that they don't get anywhere else. And then also it's exposure to a huge community. So all the people that are in this room are interested in Bitcoin, and they're working on some element or some aspect of it. A lot of times people presenting get connections to various types of partners and associates by pitching there. So that's really the value. Sometimes they get investment, and that absolutely happens. We don't really track that very rigorously, but we know that a lot of our startups do go on to get funding. I think about 20% get angel funding and about 6% get venture capital funding after having pitched at Ultralight.
Graham Lawler, founder of Ultralight Startups. Thank you very much for your time.
Excellent. Thank you, Adam.
I wonder if a lottery would be an apt comparison for what Bitcoin quote mining is, because that's kind of like what it is. Like there's some rules, you have to do these computations, and the difficulty of those computations changes so that there's somebody finds a block every, 10 minutes. But the person who finds the block is pretty much random. It's like bingo. It's like, I got it. And then, there's a block reward that comes along with it. So that's the closest thing that's coming to mind. What do you guys think about that?
I think that there's a lot of what you said there is accurate. I think that it leaves out some of the other parts because there are other factors. But as a simplification, broadly speaking, I think that works.
All right, but it's a lottery in which the person who buys the most lottery tickets decides the rules of the game and can change them for the next lottery drawing. I mean, essentially, that's the equivalence, right? So if you win the lottery, or if you buy the most tickets, then you can decide that the next time the lottery runs, instead of 49 numbers, it has 48. You get one of them. You get to pick one of them by default, and the ball machine is modified to your liking.
I don't know if that's really accurate, Andreas, because
well, it is, because you get to pick the features that go into the next client.
Well, no, but you're saying the largest player, and what I'm saying is that yes, you're right about the largest player, but the largest player doesn't necessarily have 51% of the network, which is what's required in order to make the types of decisions that you're saying that they could. And I agree with you. Theoretically, that's possible, but in terms of what we've seen so far, I don't believe that that's indicative.
I would say right now, ASIC miners in general, have the ability to choose the rules by which Bitcoin operates already, today. So right now, if there is a fundamental policy disagreement or change in the protocol, and these are happening with every version, so there's always some controversy. If this keeps happening and you have a fundamental change that affects the network as a whole, and that fundamental change comes down to a consensus vote, ASIC miners decide today. That's the case. The rest of us have no vote.
Another way that we've heard the blockchain described is more akin to pioneering land, right? Because land doesn't move, just like blocks in the blockchain don't move. You can own land, but you can't put land in your pocket, which is not true of gold. There are a variety of things that are applicable there. But do you guys know any other metaphors that work better than mining does? Because that, I think, is kind of a key problem here, is there aren't any natural ones that jump out.
None of the physical ones really work if you compare it to land. So does the person who surveys faster actually get to change the rules for how land deeds are registered? Because in Bitcoin, that's the case.
Yeah, absolutely.
So you have these weird externalities where the people who control the resource actually can determine the rules by which that resource is extracted. You can't do that in any physical system. And not just to control the rules, but control the rules by which everybody else extracts that resource. It is exactly the kind of externality that will very quickly lead to monopolistic abuse. If a market has a way for a provider in the market to turn their outputs into monopolies, they will. They always do. So the market for Bitcoin mining is not a perfect market because the Bitcoin miners have the ability to change the rules by which they produce outputs. And once you do that, you essentially control the market and can turn it into whatever you want. That's a very unhealthy market.
See, it's just a question of what the point is, right? That's what I keep coming back to. If the point is for miners to be able to maximize their efficiency and therefore maximize their profit, then I think the path we're going down is fine. But if the point is to create a robust, distributed, and resilient network that has lots of redundancy built in, so that if, half of the network suddenly goes dark for whatever reason, the other half doesn't go dark, I think that it's a bad system that we've got here, and that it was done with good intentions, and it just wasn't realized exactly what the incentives were going to lead to. So, if we're looking at this through a reality-based lens, then the appropriate thing isn't to say, well, we've already made this decision, so this is the decision. The appropriate thing is to say, as a community, what is the point? What is the purpose of mining? What function does it serve? Is what we're doing right now conducive to accomplishing that to the best possible way? And I think that, for me at least, my analysis says no. My analysis says, no, we're not doing things very efficiently. It's very efficient for people who sell ASICs. It's very efficient for people who run large mining operations or even smaller mining operations and have access to more advanced equipment. On actually what's good for distributing the network, this is not the way to do it.
I love free markets because they're the best way to match price for supply and demand and allocate resources. However, free markets are not the best way to make policy decisions about the rules by which the market operates. If you have a free market situation where the market leader can decide the rules by which the market operates, you have market failure. Always.
Thanks for listening to episode 22 of Let's Talk Bitcoin. Whether you liked, loved, or hated the show, we want to know what you think. Please send all feedback to adam@letstalkbitcoin.com. Thanks to Dr. Stephanie Murphy, Andreas M. Antonopoulos, Graham Lawler, and Martin Harrigan for providing content for this episode. Music for this episode is provided by Jared Rubens. Stay tuned for episode 23 of Let's Talk Bitcoin, releasing Friday the 12th of June, featuring more interviews and analysis. Stay tuned.